The speakers are about to arrive. Please keep your phones on silent mode to avoid any disruption.
Quality money है, if anyone can send me a doc.
A very enthusiastic afternoon to our esteemed guests, respected faculty members, and fellow finance enthusiasts. I, Vedika Mehra,
And I, Rudraksh Vora.
are delighted to welcome you all to the Annual Finance Conclave 2026, proudly organized by Finesse, the official finance club of IMT Ghaziabad.
At IMT, we believe that true learning happens when academic knowledge meets real world experiences. Insights from industry leaders provide invaluable perspectives, bridging the gap between theory and practice, and shaping well rounded future business leaders. The Finance Conclave is a testament to this vision, an exceptional platform where students get opportunity to interact with and learn from seasoned industry experts. Today, we are honored to host a distinguished panel of speakers who bring a wealth of knowledge, experience, and thought leadership to the stage. Let's gear up for an exciting day filled with insightful discussions, fresh perspectives, and meaningful conversations. We are extremely privileged to have with us Ms. Hina Kamra, Managing Director, Neo Wealth and Asset Management. Ms. Hina Kamra is a distinguished leader in banking and financial services. Ms. Hina is a distinguished leader in banking and financial services. With over 3 decades of experience across asset classes and institutions, her career spans treasury, money markets, foreign exchange, real estate financing, wealth management, asset management in senior leadership roles across banks, investment banks, NBFCs, and alternate funds. She currently serves as managing director at Neo Wealth and Asset Management, working in a strategic role within the chairman's office, rounding off her prior experiences of P&L accountability. An alumna of IMT Ghaziabad, she holds an executive program in management from Columbia Business School, New York. With a strong emphasis on governance, ethics, and value creation, and multiple recognitions as a women achiever in finance, we are delighted to welcome her back to campus to share her insights with us today. Let's welcome her with a round of applause.
We also have with us Mr. Nikhil Singhal, Head of International Business at HSBC India. Mr. Nikhil Singhal is an alumnus of IIM Ahmedabad. He brings with him deep global experience as a career private banker, having worked across markets in India and overseas with leading multinational banks. He has worked extensively with ultra high net worth clients and family offices, managing offshore portfolios across UK, Spain, and Scotland. After successfully leading the private banking business at HSBC India for over 5 years, he now heads international business for the bank, driving growth across key global corridors for Indian clients. With a career shaped by cross border markets, wealth management, and capital markets, we are delighted to have him share his perspective with us today.
Next, we are pleased to welcome Mr. Satyanandan Atyam, CRO, Tata AIG General Insurance Company Limited. Mr. Satyanandan is a distinguished enterprise risk professional with over 2 decades of experience spanning risk management, insurance, cybersecurity, and regulatory compliance. He currently serves as the Chief Risk Officer at Tata AIG, a role he has held since 2020, and also volunteers as Chief Risk Officer with the Global Association of Risk Professionals. Over the course of his career, he has held senior risk leadership roles across leading institutions, including Max Bupa, Bharti AXA, and Tata AIG, and has also contributed in advisory and program management capacities at organizations such as IBM, Mindtree, and the National Stock Exchange. A certified FRM from GARP, he is widely recognized as a thought leader in enterprise risk and data privacy, contributing to the DPDP 2025 playbook and frequently speaking on cyber resilience and enterprise risk. With deep expertise in ERM, regulatory frameworks, and navigating the evolving Indian financial landscape, we are delighted to have him share his insights with us today. Welcome you, sir.
Adding another valuable perspective to the panel is Mr. Gaurav Purti, CEO and founder of Purple Tutor. With a career spanning nearly 2 decades, Mr. Purti has navigated the intricate landscapes of financial services, fintech payments, lending, wealth management, insurance, and SMEs. His journey includes pivotal roles in sales, product management, large team leadership, and P&L management, demonstrating his versatility and comprehensive understanding of the financial ecosystem. As the CEO of Purple Tutor, a Series A funded venture, Mr. Purthy is leading the development of an AI led personalized learning platform for live classes. Educated at IIT Bombay and IIM Lucknow, he spent more than 11 years in the corporate world. He has been in leadership positions such as the head of investment products and head of business banking South Asia at Standard Chartered. In his entrepreneurial stint, he has built two companies and scaled them. He was also named in the Economic Times Young Leader Top 50 in 2011 and has won the prestigious Best Structured Products House for multiple years and the CNBC Financial Advisor for consecutive years. We welcome you, sir.
Now, completing our esteemed panel, we welcome Dr. Harsimran Sandhu, Associate Dean, PGDM BFS at IMT Ghaziabad. With a rich experience of nearly 2 decades in the BFSI sector, Sir holds a PhD Finance from IIM Indore. He has vast experience in the domain of wealth and asset management, branch banking, and foreign exchange during his association with Standard Chartered Bank. Sir being an erudite in finance, has presented papers at various academic conferences. He is also an avid researcher in the domains of behavioral finance and investments and financial services regulations. We are delighted to have you with us today, sir. Now, before we move forward, here is a short message from our upskilling partner, Uplearn by Upstocks.
Elon by Upstart Foundation, financial education initiative inspired by the vision of Mr. Ratan Tata. From learning investment basics to advanced trading strategies, AI-powered fundamental analysis, and even algorithmic trading. You've got it all. And here's something special just for this event. Scan this QR code right now and get a Learn's subscription absolutely free. Explore 75 plus courses and start your journey to financial confidence today.
Investment and securities market are subject to market risks. Read all the related documents carefully before investing.
With that, let me briefly set the context for today's discussion. The theme for this year's Finance Conclave is Decoding Budget 2026, What Future Leaders Should Know. This reflects our belief that understanding policy is no longer optional for anyone aspiring to lead in finance. The union budget is not just a statement of numbers, it is a reflection of economic priorities, risk appetite, and the direction in which markets and institutions are expected to move. Through this session, we aim to move beyond headline reactions and take deeper look at how policy decisions translate into real outcomes for financial markets, banking, capital allocation, and risk management. By bridging macroeconomic intent with practical decision making, this discussion is designed to help students and professionals alike develop a more nuanced, real world understanding of the forces shaping the financial ecosystem and what that means for the next generation of finance leaders.
To begin with, I would request Professor Arit Chaudhary to share his insights on the theme of Conclave 26.
So good afternoon, dear students. So it's a great pleasure to be here on the dais with eminent guests from the industry, Mr. Gaurav and Professor Sandhu. So this is a annual event which we have. Kudos to Finesse that every year we have this session after the budget. So let us look at last year what happened and contrast it with this year. I think after the budget this year, this is one of the fastest, time by which people have forgotten about the budget and been overshadowed by some other news, right? So last year it was not the same, right? Last year we had a big income tax cut, followed by, I think in October, a big GST cut. People were happy. The economy was great. So the fiscal deficit was under control, inflation was falling, growth was up. So supposedly a Goldilocks situation, right? So if you ask any macroeconomics, what is, good situation to be in for a country, everybody will say controlled inflation, high growth, and external, sector being, in good shape, current account deficits below, 1.5% of GDP. So it is not a, bad situation at all. But if you look at the stock markets, it completely told a different story, right? So, last year, I think, was one of the worst years as a relative performance for India vis-a-vis the emerging markets over the last 30 years. Okay, so this is why we have to understand beyond theory how markets in practice really work. Even if things in according to textbooks looks perfect, something can happen in the world which completely upends the theory. And we knew what happened last year, right? There's a certain, person which we all follow eagerly in the morning, or especially tweets mostly at night. So, and the next day people are wondering what is going to happen. So Mr. Trump doesn't believe in economic theories, right? Many things which we think are implausible, like USA attacking Greenland, suddenly look plausible now. So no matter how good your economy is, how good your inflation was, in fact, the inflation differential between India and USA last year was one of the lowest ever, because Indian inflation was down, US inflation was up. In such a situation, what should happen to the currency? Currency should at least improve. I mean, it should not depreciate with respect to the dollar. But what actually happened in reality? Dollar index fell across, if you follow the DXY is like a basket across all other currencies. DXY fell, I think 8 to 9%, and Indian rupee fell against the DXY again. So it seems like everything was very bad, but if you look at the macroeconomic situations, things were great. So, what could retail investors do in such a situation, right? Enter the budget. So budget was this time on a Sunday. People had a lot of hopes. People were talking about at least some tax relief so people knew that last year we had some income tax relief. This time, maybe to attract investors, we'll have some LTCG, STCG benefit. But in reality, what happened? You got a gift for coming on a Sunday to some, if you call children to school on a Sunday and give a punishment. That's what happened. So forget about income tax cut. There was a STT rise in FNO. So the markets behave predictably, right? So everything went downhill again. People were in depression, but then again entered the villain. The villain suddenly became the hero, right? In Monday night, we again saw that, things moved in a positive direction. So then we forget all about the budget. Now, if you look at the newspaper, okay, maybe budget is relegated to the last page. People are talking more about the trade deal, right? So this brings us to the context of this event. So we have to understand that real life doesn't behave like economic theories. Economic theories are important, but it is very important to have context of what is happening in real life as well. Guts are more important than brains, okay? And experience is more important than textbooks. So that's why we have this esteemed panel of experts to share their experiences with you. So I congratulate the Finesse team for holding this event, and I hope the students benefit from this combined wisdom of the experienced panelists to make sense of the budget and the wild markets we have today, right? So thank you for very much, and looking forward to a great discussion. Thank you.
Thank you so much for the wonderful insight, sir. I now invite our esteemed panel to step forward and commence the ceremonial lighting of the lamp, a symbol of wisdom, knowledge, and power of learning.
I thank our esteemed guests for honoring the stage. Moving ahead, I now invite Gaurav sir, our esteemed moderator, to set the stage for the conclave and initiate the panel discussion. Over to you, sir.
Thanks, everybody. It's good to be back here. And good afternoon to everybody. Has everybody had their lunch? And you're here on force or by voluntary input? Or you asked to say that? Great. But nonetheless, good to have here and good to have all of you here. And thank you for Professor Arit for setting the context and making my notes redundant because he said everything. Right? But nonetheless, I want to talk about a couple of things. Firstly, the fact that there have been a lot to cheer about. And it's almost like the way I see it, it's like students when they're waiting for the result of a competitive exam and seeing their name on a merit list, if they're there or not there. And guess what? Last year, you had many times when you were there on the merit list, right? You had cheer when you had the budget which introduced the income tax reform. You had GST cuts. You had the mother of all deals. And well, about 2-3 days ago, you had that case where the tariffs were dropped from 50 to 18%, right? And markets were cheering. So there were many, many times. The global context is very, very important to understand how the budget proceeds, right? And what is the outlook, right? And if you see last year, one of the things that was said by the finance minister was Viksit Bharat by 2047. Do we remember that? Anybody? Great. And they said that we want to become a 30 trillion economy by 2047. And the next 5 years, we want to overtake Germany and Japan, right? If you recollect. And last year, guess what happened? We overtook Japan. Yeah. And there were many other things. The fact is, a lot of this is continued over the year, right? And this year has been a little different in terms of the budget. Yes. We have seen weaponization of tariffs. We have seen global uncertainty. We have seen to some extent de-dollarization or dependence on dollarization, dollar being a little less. And guess what? Commodity prices have gone up. Have you followed that? Silver, gold, has anybody seen the kind of way they have behaved? Yes, the global context is very, very important. And what we see in this budget is you had so much of focus on rare earth. You had many, many things in terms of the capex spending increasing year on year, the fiscal deficit being managed. So you've seen a lot of fiscal prudence coming through. Having said that, context is one of the most important things which is to be taken into consideration whenever you're designing the budget, right? Especially in this time of global uncertainty, right? Whatever your budget is going to be a function of, well, internal dynamics and external dependencies, right? And this is what we aim to do with the discussion out here. So feel free to participate. We'll have a discussion and then possibly move forward in terms of a Q&A. So I look forward to everybody asking a lot of questions and not just the planted ones. Yeah. Hello? Yeah. Oh, perfect. So, first thing, I think one of the things that we saw was during the budget, especially towards the latter half and the end, we saw the markets obviously reacting very negatively to the entire news on the STT, the securities transaction tax, right? Especially being laid on derivatives. The fact was this was drastically, increased. And one of the things that we see in the derivatives market of India is that, yeah, from a notional perspective, not in terms of value, but in terms of volume, we do see a large amount of volumes go over there. In fact, India is the largest derivatives market in the world by volume, not value. And for every 1 rupee that is going into the cash market, about 400 rupees or thereabouts, depending on the time that you see, that's the amount of volume that we see in the derivatives market, right? The other fact is 91% of traders seem to be losing money, right? The question over there is that while a lot of this is happening, and to maybe Nikhil, who's involved in some of this, how do you see the market reaction in terms of the STT? How do you see it playing out in this year. Do you think the STT is going to have an impact? How do you see, and what are the measures that have been taken? Are they good enough to reduce volumes, to make sure retail traders don't lose? How do you see it sort of panning out? And before that, Nikhil, before we move to the derivatives, I just want your overall take on the budget first. And what do you think the overall take was? And what do you think was also missing from the budget, which you would have wanted to see?
Okay. Great. Can you hear me? Okay. First of all, Professor Arit, I think you spoke really well. Loved the description of Goldilocks and dollar index, etc. These are very real things. And more importantly, the way you connected differential interest rates to the currency. I mean, this is real economics. And this is something that all of you should understand what he was trying to say. So thank you so much. I think I really connected very well with all those pointers. And of course, Gaurav, you started very well. Now, let me just give you an idea of step back to say what budget means and what this budget really was. The first pointer for me always is, does the maths add up for budgets, right? You don't have to make bombastic announcements which don't add up, right? The first and foremost thing is maths real? So when they spoke about a 10% nominal GDP growth, do we believe in it? The answer is possibly a yes, because nominal would mean, if I look at the breakdown, roughly the inflation, even if with an uptrend, is likely to be somewhere around 3 to 3.5%. And so if you look at a 6.5 to 7% real GDP growth rate, that looks like a number which is totally believable. Second is they are talking about in the maths of revenues. I mean, you have to look at both the revenues and the costs. You're talking about a bulk of the conversations happening around capex, right? Capex, they've kept it as 3.1% of GDP, which is same as last year, but because GDP is expanding at a faster clip, obviously your capex expansion is there at around whatever, somewhere around 11 odd percent year on year. But if you look at the capex spend, including the state budget, which is the tax-free, the interest-free loans that the center provides to the states, the actual capex is about 20% growth. Now that's a huge budget outlay. And within that, they've of course prioritized sectors. We will talk about that. But the question then is, where are you going to find the funds when you've just done a GST cuts, which are substantial? So the budget, if you read through the fine print, actually says that they're not going to have a very big jump on the indirect tax, right? They're actually talking about a tax buoyancy of 0.3 or something. But the other bit is the direct taxes. So direct taxes, they've shown at around 11 to 11.5% corporate and personal taxation put together. Are these believable? The answer is yes. They are not very, very optimistic projections. But still, you're going to be left with a deficit to fund. And that's where they've also said that, okay, we're going to fund this through extra borrowing, right? And which is where, of course, the GSECs have sold off and all that. But at least they've been honest in their projections that we are going to borrow. They've also said that I'm going to have an extended path to fiscal consolidation. So from the expected for this year, as per the glide path, was supposed to be 4.2%. They've said, okay, we'll stick at 4.3, which means we personally feel as a house view of HSBC that these numbers are but it's actually gone through. Space is what we're excited about. And yeah, I mean, lastly, we're always evaluating budget from a standpoint of, is it adding to the vision? And the biggest delta, and of course, capex, etc., defense, manufacturing leading to exports, etc., manufacturing, PLI, all of those were good. But I think the biggest sign of it, and Gaurav briefly mentioned about, was the fleet-footedness of the government here to say that they've taken a step around data centers. Now, this is going to be a big thing because they've said we're going to give you a long tax holiday till 2047 if you are a data center for global offices. So you are basically playing to the new generation of ideas, and that we feel is very good. And of course, rare earth corridor announcements, etc. So if the budget has vision apart from the steady state capex allocations, we will be very happy with it, because this whole noise is very temporary. The growth, the macros build over a much longer time frame. And to this noise element, I'm just going to take your question on the STT bit. See, I think the STT element, of course, we're all reading through the lens of speculation to be curbed, etc. And because 90% retail investors lost money in F&O trading, fair enough. And there are various ways to do it. STT, see, equity markets are very sensitive. They don't like disruptions. The bigger problem was equity markets were expecting LTCG cuts. On the contrary, they were loaded with an STT tax. But I mean, if you were to just cut out of the noise part of it, speculators are important because they provide liquidity and price discovery. So they're very important. They're not going to go away. I think this has also tried to hit to another problem, of course, outside of the retail part, is that there's a large industry of arbitrage funds which basically buy in cash and sell in futures. And they have a tax benefit by design because they're taxed as equity while they're equivalent of a cash and kind of instruments. So while liquid plus, etc., are all taxed as debt instruments, these were taxed as equity instruments. And a lot of the money was entirely short-term money, was all going only into the arbitrage funds. With this change, the arbitrage, the post-tax returns of arbitrage funds versus the liquid funds, the differential has come down from, let's say, about 1.2, 1.3% to now about 0.9 odd percent. So in a way, it's an indirect way to also curb that sort of artificial gap, because the risk profile of both the instruments was similar, but the taxation treatment was different. So yeah, that's the way I would look at it. Long-winded answer to a
Just
simple question.
one thing before I let you go, Nikhil. So what do you think you expected in the budget and didn't come? While you did mention about was it the LTCG cut not happening, or was it anything else?
Well, I think the LTCG, if you ask me as a house, we weren't really calling it out to say that this should be expected. I mean, honestly, we were not looking at some major stuff. I think, to be honest, we were pleasantly surprised with the inclusion of data centers, etc.
Right.
Because even our bank has a very structured view around GCCs and data centers, etc. So we found this as a forward-looking surprise element. And of course, rare earth is a big story. I think the only bit that I have an element about is how do you focus on creating strategic reserves on crude? Now, that was a story which started 10, 15, 10, 12 years back, but somewhere it's not being spoken too much about. We are not aware how much it's happening, not happening in terms of the quantum leap. I think that's one area we would expect more traction.
Got it. Thanks. I'm going to come back to you, Nikhil.
Yeah.
Maybe Hina, your view on the budget and one thing you expected. I think it's on. It's on. Yeah.
I think this is a budget which was more in continuum. There weren't too many shocks. Of course, STT, something like this would have been expected to my mind, because last 2 years, all the regulators have been talking about the losses made by the retail investors. And but otherwise, it was a fiscally prudent budget. It was more in continuation that was there. And I think Nikhil managed to cover most of the parts that one would talk about. A very balanced approach. Yeah, and in terms of Make in India push, probably a little more focus has been given, which we can actually see if you look at the semiconductor policy, the AI push, which has just started, the freight corridors, rare earth, which are actually globally driven and more in line with the Make in India push, which started, or the production link incentives, which started a couple of years back. Again, the legroom for the government to do too much more while remaining fiscally prudent. If you look at our fiscal deficit in 21, it was at 9.7%. They brought it down to a commendable 4.4, 4.3%. And the numbers that were projected, they actually look doable. Again, totally in line with what Nikhil said. The numbers look believable. They're actually believable numbers. They could have projected 4%, 3%, or thereabouts. But it also means that the legroom for the government to reduce it further is very, very limited, looking at the capex requirements of the nation. So we are not really expecting it to come down to 4%, 4.5%. On interest rates, again, our understanding would be that probably another 25 basis points cut from thereabouts, more in the monetary policy. Again, no major shocks. Overall environment is very, very conducive. If we don't talk about the global context, if we look at just the Indian context, and of course, we can't overlook the global context, but the local environment seems very, very stable. Your NPAs are at a multi-decadal low. In fact, I've been talking to a lot of asset reconstruction companies. What we hear from them is most of the issues have actually been resolved. Balance sheets have been looking, corporate balance sheets are in a good shape. Banks' balance sheets are in a very, very good shape. So inflation is largely under control. So at 2 or 3%, these are good numbers to have. And it's a stable interest rate environment. We might see some interest rate cuts over the next couple of months, probably as early as this week. Let's see how the government goes. So overall, in that context, to have a stable local environment, local macro environment in a globally volatile macro and geopolitical environment is the right place to be in. So overall positive. Thank you.
Anything you think you expected and was not there in the budget?
I think more or less in line with expectations. I just have one point to make, and this is, my career started off with the bond markets. And yes, this time I'm talking about the early 1990s. And this time they've come out with something called total return swaps. We'll have to wait for the fine print. It'll come out in the next couple of days in the monetary policy. But the devil will be in the details on what is exactly the fine print. India has yet to meet its promise of a well-developed corporate bond market, despite interest rates were deregulated in sometime in 1992. It's been 35 years, and our bond markets are still very, very underdeveloped, and the loan market is far bigger than the bond market. I think it's time that we did something a little more. So
I want to come back to you on that one, Hina. Thank you so much. Maybe we pass on to Satya, who could tell us his view on the budget and one thing that he expected and maybe it was not there.
Well, I think the entire narrative around the physical deficit, the entire narrative around the capex expenditure, I think this has to be understood from a certain context. I want to build that context now. We have been hearing a narrative around this is the second budget in the second quarter of the 21st century, and with a target of a Viksit Bharat in 2047. Now, any plans which are laid down are always with an objective and with a target. And when you have a target of a Viksit Bharat for a government, so there has to be initiatives in line with that. The narrative around fiscal prudence of what is the type of capex expenditure we are having and what is the physical deficit, we come to 4.4. We are attempting to 4.3 for the fixed financial year of 26-27. We need to have a benchmark understanding with what's the debt GDP ratio and what's the physical deficit of the developing countries in the top 10 or 15 countries in the world. Are we faring bad? Are we faring equally? Or we have a room for more capex expenditure or of better or more leverage of debt to GDP? Now, if you compare the numbers, I think numbers would speak. If you see the developed countries like US, Germany, multiple other, they are at the debt GDP ratio of more than 110, 120%. Japan is at 220%. The physical deficit of them are at 5.9, 6.5, respectively. The China is at 6.5. Now, the entire narrative of the budget with the target of Viksit Bharat is all about being a developed country. And you need to have a developed country, need to have certain product-based, asset-based services. It's not a service-based nation. You need to have a nation where you have products, where your GDP is driven not by services or vulnerable services, which is, not a very strong proposition, but more of an IP through our products. If we have a certain direction, do we need to invest now with the right capex, with the right initiatives? I think those initiatives have been in place. And for all those initiatives with the infrastructure and everything, the spend, you need to have those capex investments to be made. So benchmarking with other countries, I think we are not bad. Our fiscal prudence is still there with the inflation at low. We still have a leg room for making the amount of capex investments, what we have already proposed in the budget. As rightly articulated by Nikhil, though our GDP has increased, so our percentage contribution of the capex still remains 3%, but it's a 7% increase from the previous year. So I think it's quite justifies with an objective, with a comparative of what is across the world, and with our own objective of what you want to attain. Now, coming back to the efficiency part of the budget. You have seen the capex investment under the Nikhil Kadikari and multiple other transport ministry, what we have done in last 10 years. The final print of this gives you a lot of important message. They have talked about creating an infrastructure risk guarantee fund. Have you read that? What it is all about? It is solving problems. Typically, when you have private developers who comes into the infrastructure projects, the lending companies, the banks always have a step behind because the type of complexity in the project delivery, the lending companies have risk around the funding which they do, and the project doesn't get to the end of the life, they don't see the end of the light. 2 years back, the government of India came back to insurance companies to offer surety insurance as a product. Every developer needs to offer a bank guarantee to a bank to get the line of credit from them. And when you extend a bank guarantee, you are blocking a significant amount of capital. When a private developer blocks a significant amount of capital, which is not yielding any ROE for him, and which is not yielding him the ability to execute a project because that capital is required for him to execute the project, you are actually creating the drift, the necessary or unnecessary drift in his project. So the government of India came back to insurance companies 2 years back saying that you develop a surety insurance, that whenever a bank asks for a bank guarantee, the developer will buy a surety insurance and he will offer it to the bank, saying that if at all the project fails under such circumstances, the insurance company will pay you and the bank gets the comfort. And then they kicked the entire infrastructure journey. But now the budget failed. The government felt that it is not enough. They created an infrastructure risk guarantee fund so that there is a greater amount of leverage, there is a greater amount of financial comfort, and there is a greater amount of, I would say, reviving the infra projects and removing the financial bottlenecks. This is one piece of efficiency. So all the initiatives, what I think my co-panelists talked about, the semiconductor mission and everything, are all infrastructure pushes so that we develop that IP and develop that amount of revenue from a capex investment, we get over a longer period of time. So that is something which I wanted to summarize, and we have the final print of the budget, which needs to be understood because the broader aspect and the competitor aspect or the industry benchmarks across the different countries also has to be understood. so that we understand the physical prudence is being taken care and there is an objective to be seen. There is a runway to the objective and that is being there. No, I think the entire intent was not to offer tax incentives and get the, a low hanging fruit to be offered to the citizens of the country so that people do appreciation of the budget. And there's a great amount of narrative in the media that the government is pro people. I think government has become more responsible now in terms of attaining what it needs to attain for the Viksit Bharat objectives. So that's the summary what I want to say to start with. And that's the point, Gaurav, I wanted to make.
Sure. And your quick 10 seconds on anything you expected in the budget, which was not there.
I would say this is a more mature budget. This is not a low-hanging fruit budget. This is a very, very mature budget. I never had any expectation that government would think in that fashion. So I would say there is a lot of narrative around insurance penetration and the composite license offering, and there is amount of clubbing of lot of PSUs. The disinvestment target of 80,000 crore have been taken this year. If you have seen in last 2 years, there has been no significant disinvestment done by the government. They have their own reason because the sector was not ready, the growth was not there, and they have taken a target of 80,000 crore, and which the FM has already told that she has very clear initiatives to do it. So the intent is actually demonstrated by the target they have taken, because earlier the target was not taken in the previous financial the budget. So this gives a good amount of confidence that I think the intent is correct. And if the government comes again and again, I think this is going to give us 8% growth. I think there's always a narrative, Gaurav, in the wealth management space, Hina, they say that if the Nifty is growing 8%, GDP is growing at 8%, vote for BJP. I think that's a humorous narrative that happens in the market. So everything is actually demonstrated in that way. Yeah.
Thanks. I'm going to come back to you on some of the insurance stuff. Professor Harsimran, your quick take on the budget and one thing you expected was not there.
So thanks, Gaurav. So I look at budget from this perspective. It's all about C plus I plus G. Am I right? Which lever you are kind of putting out of the C plus I plus G. So the first, if you look at the previous budget, it was C. You're cutting the interest rate to putting up consumption, and try to think about the government has been the heavy lifter in this case. Last 4 years, it is all about government capex. This year, the only thing they wanted that I to kicking, which is private capex, which is industry to, this is not happening. Am I right? This is the area of worry. The other lever, which I normally don't look at the overall, what is the GDP and growth and all. The number I look at is per capita GDP. For me, that has to move. Am I right? Ultimately, what is per capita GDP of our country? We are at $2,800. Am I right? We might say that we have the 4th largest economy, but that is the reason we have to move in that direction. Am I right? So I think important portion of this budget is that the private capex has to kind of kick in. Am I right? Government is doing everything. This year also, government capex is higher than the last year. There is an increased expenditure in defense. In fact, all the countries, maybe look at the European countries, everybody is increasing on defense, more or less. I think the area of worry is the middle household, which pay the maximum amount of tax, is going towards highly leveraged side. Am I right? And the job growth is on the lower side. So you look at the previous RBI financial stability report, which clearly says that this is the highest per capita debt for a middle class household, and that cannot push consumption. So I think government has to kind of think about that, how to increase private capex, how to start that cycle, and also look at how to kind of support the middle class household, because that's the big amount of the income tax that pool has to this thing. So Gaurav, I was thinking about something on the long-term capital gain tax that could come, because that can kind of push long-term investing in equity funds. I thought they can give some kind of a break after 3 years, maybe making equity returns tax-free after 3 years. That was one of my expectation. I think that MFI has also kind of put forth in their recommendations to the finance minister. Yeah.
Thank you to all the panelists. And I think some of the common themes that I get is that numbers seem to be in line, fiscal prudence is there. I think Nikhil spoke about the fact that reforms are now continuous, and welcome to see the things that they saw on data centers, AI, rare earths, freight corridors being developed. I think Hina spoke a lot about some of these things, that the numbers are believable, and interest rate cuts that are due to happen. And refreshing to see that the Make in India is again something that we see that's being a part of it. And Satya, again, speaking about the focus on Viksit Bharat 2047, and again, surety insurance and GDP through IP through products again. And I think Professor Harsimran very rightly mentioned the kind of levers, the per capita GDP being one of the most important parameters to be looked at. And again, private capex may not be happening in the right way or at the acceleration at the pace that we want to. And again, mentioning the middle class, and we are at the stage of the highest per capita debt and job growth. I think some very, very important points we mentioned, and LTCG and capital formation. So Professor Harsimran, I'm going to come back to you, I think, on the question we started with on the STT impact. And I think you mentioned that capital formation happens in the equity markets. Now, when we look at it, you see the STT impact. Coming back to it, do you think it was done because of increasing collections or reducing derivative trading? And if so, what do you think more needs to be done? Because if we see, even last year, the 91% of losses have moved to about 80, it's still 85, 86% right now in the last year by the recent data that is published. So the slew of reforms by SEBI have not really taken that kind of an impact that has been estimated. Do you think more needs to be done, and what do you see it as?
So I think, lighter note, I see ST tax as a sin tax, what we put on cigarettes actually. And I think when the options and futures came into India, they were looking from a hedging purpose. Am I right?
Yeah.
Look at all the structured product in AIF 1, 2, 3 category. They're used as a hedging and a structuring process. What is happening is in retail, people are trading and losing money. Maybe if you look at the SEBI report, 80-90% of the people lose money in this case. I think government is quite cognizant with this fact, and they have raised the cost of trading, maybe more or less, and it would have an impact on liquidity. But I don't think so. This has a huge impact for investors who are investing for long term in that case. So I see this as a syntax and maybe dissuading the retail investor to not go for trading and lose money in the equity markets.
So maybe more needs to be done.
Maybe look at the Jane Street thing. This is a classic example where most of the retail investor lost money, and the entire gain was with a large algorithmic firm.
Absolutely. So maybe suitability and all maybe needs to be done a lot more. So, and like you mentioned, capital formation happens a lot on the equity markets. The other market that happens where you see a bulk of capital formation again is the fixed income, the corporate bond market, right? And I think the other one, Hina, you mentioned a lot about it. And we have seen, well, other global economies, developed economies, the corporate bond markets are fairly well developed compared to India, where the trading volumes are fairly low. We see most of the volumes being in G-Secs even today. Obviously, there was a focus towards, having market making mechanism, total return swaps, derivatives, as well as, higher issuances of municipal bonds, those kind of things that we saw. How do you see the corporate bond market developing from here, and what do you think more needs to be done?
If we look at the overall context, Indian interest rates were deregulated in 1992 after the liberalization. But if you look at the extent of the corporate bond market, it's just not developed, right? So we're obviously, there are a couple of things which we have actually missed out doing. Your GSEC market, we've gone, I think it was somewhere around 50,000 crores. It must have been 95, 96. We're talking about 11, 12 lakh crore, 13 lakh crore today. A simple method which the RBI used to develop the GSEC market, which aided the borrowing of the government and funded a fiscal deficit, was to introduce the concept of market making by introducing primary dealers, whose job was to provide liquidity in the GSECs market. Something similar could always happen done in the corporate bond market also, and it's still not too late. Have a concept of a primary dealers in corporate bond market. Probably the existing corporate primary dealers itself could be incentivized to do the market making for the corporate bond market also, which could be in the form of commissions, bidding, annual targets for trading, providing two-way liquidity for small ticket, say 1 lakh, 2 lakh rupees, 10,000 rupees. So that's one. Second, if you look at factual data, the loan market in India, would be roughly around 80-90%, if I'm not mistaken, of the total volume of the debt market. It's still the loan market. Banks, who are the largest investors in debt or credit, anything which is fixed income, I'm saying, let's call it fungible between loans and any other fixed income instrument, which could be corporate bonds, NCDs, or anything else. 80 to 90% today is still loans. So banks prefer to do loans. The largest providers of liquidity in the market, they prefer to do loans. There's one fundamental difference. Put bonds and loans at par. Banks, when they're investing in corporate bonds, need to market because it forms a part of your treasury book, except, of course, unless it's held to maturity and so on and so forth. Loans do not need to be marked to market. Put bonds and loans at par. The third thing is, if you look at the US markets, which is the largest bond market in the world, why is it that why do you call it the largest and the deepest bond market in the world? Because you have a continuous yield curve across maturities, across different grades of credit. So whether it's someone is the borrower is raising funds at 3%, or whether it's 30%, or whether it's 40%, it's a vibrant two-way market with a price discovery mechanism with active buyers and sellers there. Institutional participation, retail participation, everything across tenors. And why is that? That is because the hedging mechanisms across these tenors are available. Again, there too, you have liquidity in the market making mechanisms. Again, different types of players and participants in the market. Now, if you look at relatively the Indian markets in comparison, we've not yet developed those hedging mechanisms to the extent that they exist in the US. At times, guidelines have come out, but then we do observe that, of course,
The mic.
yeah,
I think
you
that's slightly
do
more.
you do observe that even in the US markets, every few in the US markets and all, you'll see every few years you'll have some kind of a scam or something, some kind of imbalance, some kind of speculative activity, which becomes a kind of systemic risk. So while we've been very, very prudent in having an actual control, where we are not allowing these instruments to become tools of speculative activity and disrupt the debt market, the way it's disrupted the equity market. And we said futures and options is something you increasing it.
Yeah.
But market making and a couple of other things, those are things that can be implemented. Again, interest rate swaps, interest rate futures across tenors, a deeper market is required. So these are some of the basic fundamental things. If we develop that market, I think the Indian overall financial markets will be far more balanced and far more mature.
Thanks, Ina. And I think some of these points to everyone in the audience, I think you're not going to get them there in your textbook, especially like the mark-to-market piece of loans versus corporate bonds and how banks sort of, are sort of constrained by. In the same context, and maybe to you, Nikhil, obviously Hina spoke about liquidity, and I think there have been 2-3 things. One is that you see now retail bonds being available at much lower ticket size, at least in cases of, let's say, even 10,000. And even last week, there was talk of SEBI where they're going to say that, you might have a similar MFD, mutual fund distributor-like model for offline for bonds. So while obviously depth is not there, in Hina spoke, especially on those kind of aspects, do you think more needs to be done, or do you think a lot is being done? Your quick 1-minute take.
Yeah. So I think first of all, important to understand the size of the fixed income versus the equities. Fixed income is a much larger piece. Globally, this market is about $140 odd trillion versus the equities, which is a smaller version. So about $110 trillion market cap. So fixed income is the darling. It's the bigger space. But like Hina said, the Western world is a lot more pronounced versus, the fixed income space in India. Partly because, when you do these fixed income instruments in the US or anywhere actually in the Western world, they are a lot more fungible on capital convertibility. So they are able, a lot of the fixed income market has inbuilt leverage in it. So you would have heard of, yen being the preferred borrowing currency. So is Swiss francs, because their interest rate sensitivity is very, very low traditionally. And generally they've been on a depreciating trend. So if you're borrowing in that currency in which depreciates, you're always going to make money. So globally, fixed income is done with the intent to keep positive cost of carry. So you will do an investment in a bond, typical corporate bond, but with leverage. That story, unfortunately, will be difficult to play out in an emerging market scenario like India, because typically the cost of funds in any emerging market will tend to be high. So you will end up, so for instance, if you want to get into a high quality corporate bond, obviously you don't want to get into a delinquent sort of portfolio. If you're looking at a high quality corporate bond, it will always come with a negative carry, which means the uh, cost of funding will be higher than the amount of interest that you're going to, or the coupon you're going to have in this paper. So which is why the corporate bond market in India is relatively shallow, and a bulk of it, like Hina said, is in GSECs, and let's say the AAA corporates where the spread is not more than 70, 80 bips to the GSECs. But beyond that, the markets become extremely shallow, because if let's say at today's GSEC yield of 670, 675, the top corporate bonds will be trading at, let's say, 750, 780 spread, 750, 780 price band, yield band. But after that, if you go below the risk, you don't have, like Hina said, the continuous risk spectrum will not exist. It will suddenly be a big vacuum, and then you operate at 11, 12%. So I think that's where the gaps exist. Now, one panacea for this can always be that if you get into, today you have a capping on borrowing in foreign currency for pure speculative reasons. If let's say the LRS guidelines were to be relaxed and capital convertibility comes into India, you could very well be buying a, let's say hypothetically, a Citigroup bond of 5-year maturity, 5%, 6% dollar yield, but borrowing in yen. That will suddenly change the scope. Of course, that's from an investor point of view, but his interest in fixed income will arise. And yeah, I mean, so I think the real story is very simple. The risk spectrum in India is today not full, and the very high quality papers, because of the rush into it, do not offer the yield uptake for you.
Very insightful, Nikhil, especially on the products that you mentioned in terms of how structuring happens in a product shop to actually give high dollar yield products, right? And where borrowing can happen and where yields are, and why India is possibly not well poised to have these products, but hopefully in the near future we will. So thank you for that, and I hope students took note. And again, coming back, Professor Harsimran, again, coming back to the whole piece on capital formation, the corporate bond market, and liquidity and debt, what do you think more needs to be done, if at all?
So I think everything is taken away from by the government. Actually, there was a tax arbitrage indexation that is taken away. And if you look at the long-term inflation is about 5 to 6%. And if you do after tax for bond returns, it's negative real estate. So it's completely non-attractive. And look at the flows into mutual funds in the debt instruments. It's nothing actually. So for a very long period, mutual funds were the cheerleaders for the bond market, am I right? At least for a AA and AAA. And we have kind of nil liquidity between the BBB and below. Even the median rating, I would say, is BB. So try to imagine in a BBB, which is a one-to-one transaction, it is not even traded in the market. So if you look at the actual trading in the market is between AAA and AA, and there is very thin liquidity, which is just kind of a counterparty kind of a thing for low-rated papers, and completely non-attractive because that you're taxed on the highest rate, and inflation being at long-term being by 5 to 6%, you're negative. So I don't know what government can do to make it attractive, because all the other tax breaks have been taken away.
Right. I think a very, very tricky situation. Yeah, Hima.
I'd like to add one more thing here. in development of the debt market, you'll read a lot about these high yield papers which are being offered by a lot of platforms. So retail participation is actually increasing because let's say you just had 2 lakh rupees, 3 lakh rupees of surplus, or let's say 40,000 rupees of surplus. Where could you invest your money? It was just in mutual funds. Let's say the liquid mutual funds, the debt funds at 7-8% or thereabouts, or bank FDs. So the Indian diaspora has not had the general, by and large, the Indian diaspora has not had access to different uh, avenues of investment in the fixed income market. A few entrepreneurial ventures over the last few years have made high yield debt available to the Indian diaspora. And it's really proliferating. The 17%, 8%, 18%, 19% paper for 10,000 rupees, 20,000 rupees, etc., etc. The appropriateness and the understanding of the investor here, I think some guardrails need to be put in place, because this could actually become very, very critical in case of defaults. We've been lucky. Last few years, the credit cycle has been good. Corporate balance sheets are strong. They have been, it's a very conducive interest rate environment. If that changes, the investors could be at risk. And I think the regulators are cognizant. They have started coming out with guidelines, but some more guardrails would definitely be required.
Yeah. So, Ina, I just want to add, I always look at this risk. We are buying a double B paper in a triple B minus economy. Just remember this.
I would like to challenge that because that triple B minus is a rating given by international rating agencies.
Yeah.
The
High risk. It's double B is a high risk in this country. So
Yeah.
people have to be very aware that they're investing in very
Yeah,
high
yeah.
risk.
But the way I started off was that you have risk and reward. So if I have a sub investment grade paper where I'm getting 25%, I should know that 25% comes with its own set of risks, and 7% will obviously be at a different level of risk. The only thing that I was debating was that I hope the investor knows that.
Yeah.
And if you go to SEBI websites and SDL websites, I've seen there's a lot of investor education actually happening on these websites
Yep.
for the retail investor.
Yep.
But probably a little more would really help, because as we've seen the proliferation of futures and options, and there's so many
But
stories.
people very little understand lower rated papers, what kind of risk
Yeah.
they can have.
I
So
think-
you have to be.
Yeah, suitability is a
Gaurav,
big.
I think everybody is transgressing into my area. And if I keep quiet, I think it would not be fair.
Sure.
So I think I need to justify my role in the entire scheme of things. So Hina, and so the entire perspective of a default risk, we all talk about investor awareness, but the amount of default risk we see in these papers, and the type of real estate financing also what we have seen, the amount of papers which have come, which are more of a structured project which have come in the industry. The default risk is something which is come which is not coming under the scanner of SEBI or the regulator itself, because these are under the scanner. I would not say they have even under the regulator has any visibility of what is the practices happening in the industry. So this comes with a lot of default risk, and I would say they are more frequency. The frequency of default risk is huge, where the investors have gone, taken for a ride. So though we talk about the depth to be created, I think the depth to be created in this way may not be a right way. I think the US bond market has a different story, and Indian bond market is a different story. And to get into a depth from a perspective, I think there could be other means and ways. So the limited point I wanted to make, end of the day, my domain. So I can't allow people to transgress without me talking about it.
No, great. Thanks for your input, Satya. And, I think I also want to understand from an insurance perspective, given you're from the insurance domain, and while you did speak about, the risk, and fixed income, corporate bond market. But Also, from a perspective of the insurance sector, we saw a certain amount of reforms for insurance that were there on motor claims, but which is, on tax exemption, etc. But what do you think more needs to be done, especially in that segment? And while motor is the most of the sold product, but in the other sectors such as life, health, what do you think more needs to be done in that?
So Gaurav, the example which you gave in the budget was more from a consumer confidence and giving more from a consumer standpoint. So I would come to that point later. I think from an overall sectorial, confidence in terms of, see, end of the day, what does regulator do? What is the obligation of the regulator? The regulator has to expand the market. When you say expand the market, what does it mean? You want to attract capital. When you want to attract capital, what does it mean? Do you want to create a playground of a very competitive culture, a right standards, risk-based capital? Do you have a risk-based capital in India? If you have an operational risk, do you have a charge on the solvency, charge on the capital? Do you measure that? Do you say the equity exposure has a certain charge and therefore you ensure that a certain charge is applied to your capital? So do you have a risk-based solvency regime? Do you have a risk-based supervision framework? How are your accounting standards to your IFRS global accounting? The guys, you are management graduates, by trying to connect to the people. And Gaurav, excuse me for that. What is important is to understand the insurance accounting. The accounting is a conservative accounting. When you say conservative accounting, it is all about creating reserves. The reserves are the huge part. Whatever premium you earn, you do not book it as the gross written premium. That is what you earn. You have a lot of conservative reserves which are created, and what the net profit is all about the type of investment income you made and what are the underwriting operations you made. End of the day, the capital which is always there has to be charged for whatever risk you take as an organization. The equity exposure, the operational risk exposure, the market exposure, whatever exposure you take, you need to have a right charge on the capital. This is the framework which regulator wants to build in India. This is a reform what we have already taken. It is going to be implemented. The IFRS accounting. Because of the conservative accounting what we have, IFRS is going to totally change how you exactly see the P&Ls are being created. Your costs are upfront in insurance, and whatever the cost you are taking in terms of the commission and expenses is upfront. But whatever the premium you earn is over a period of the contract. Many a times you take a 5-year contract, you have a 2 years contract. The premium is apportioned over the period of years, but your cost is upfront. So is it a fair accounting standard? It's not a fair accounting standard because your P&L is not reflective of what you earn and what you spend. So I think from a point of reforms, I think having a risk-based capital, having a risk-based supervision framework, having a IFRS accounting are already reforms already on the pipeline. They have a certain clear window of 2026-27 where things have to be implemented from an IFRS and RBC. And risk-based supervision framework is also something we have already started. We have already gone to two cycles. The Tata AIG is one up in the leader and selected because of our own governance practices. So these are the reforms what we are expecting. There are whatever we see on the composite license. We are also talking about having a efficiency of operations. That if at all there is a life and general insurance license given to one organization, you have efficiency of operations and you are able to reach out to the customer more efficiently because you have operational efficiency around it. You have a consumer product of life and health, which is more of a synergy, and motor is definitely there. So these are the type of reforms which we are seeing in the industry and which will create a regulator, which create a level playing field to attract capital, attract investors, international investors, the private equity firms, so that they see that the practices in India in how you run the business are of the international standards, so that the capital inflow outflow can be really measured in terms of the actual dollar inflow and dollar outflow and what is the amount the business is generating. Because if at all there is so much of discounting in India, the dollar income you earn cannot be equated to the dollar income you earn in the US or European markets. So there has to be a fair accounting standards for you to benchmark that. So there are a few things. And maybe when you are talking about, insurance, as I talked about the one thing about what the budget is doing for that, I think there are other things which are outside the budget, which has now come under the periphery of the budget. These are reforms which are coming to the sector and where you need a lot of finance people. You need a lot of finance people, the graduates like you, the postgraduates like you, who need to really get into the pricing of the product. Because insurance is a complex product. The pricing of the product, actually how it is priced, there is a skill known as actuarial skill. How you price the product, how you actually underwrite the product, and how you propose the product to the customer. So this piece, there are a lot of innovation happening. There are a lot of fintech firms which are coming into place. The tech, what you see in the fintech space, the insure tech is also growing hugely. So the amount of fintech now, because you are seeing a lot of parametric products. Parametric products are such products. Let's say you have a delayed flight. Because there is a delay in flight and that data is actually directly given by uh, the airport authority to the insurance companies, nobody asking questions to you. For a certain delay, you get a default amount which is credited to your account. So the amount of pricing, the amount of commoditization this industry would see around parametric products is the future. The AI would be again the future, where it will talk about prevent rather than detect. At present, the insurance companies or the sector operates from a detect and pay. It would become prevent and design. That is how you are able to have a right design to prevent the risk. So a lot of things are happening. I think though we have a limited time, but this is something I wanted to
So
show.
thanks for your insights on insurance reforms. And I think, like you mentioned, flows are very important in terms of making sure flows go to the right industry for, again, development. And none more important than the global Indian business or NRI. So maybe Nikhil, to you, since you've moved to a role which is heading the global Indian business at a large MNC, what do you see more needs to be done? Is there anything on the budget? And again, what are you advising portfolios? And again, just request a quick 1 minute answer so that we can quickly move to Q&A.
Yeah. No, I think, see, the global Indian business is not different from what a regular resident Indian thinks. First of all, because 20 years back, they were sending money, the Indian diaspora was sending money as a sustenance money to support their family back home. Today, they're looking at pure, their capital is chasing Indian markets, both real estate, alternates, listed equities, unlisted. So they're no different. So there's a huge opportunity. This business is Indian diaspora is actually very, very rich. The story which the the budget, Union Budget 2026 is looking to tap into is interesting because they've invested heavily on GIFT. GIFT is an offshore booking center which allows resident Indians and in a big way the NRIs to be able to keep their reserves in the currency, the foreign currency of their choice. So earlier they could only keep the monies in deposits in India as an FCNR, etc., which was highly restricted. But today you can, using Gift City as an offshore booking center, you're able to use you're able to tap into the entire India growth story with the foreign currency. So the real story is they want to do alternates, you want to do private equity, private credit. Through the gift route as a vehicle, you're able to tap into the capital markets part, both the listed and the unlisted space. And to my mind, the way the government is talking about it, 5 to 10 years from now, it's going to start to challenge the DIFC model. So it's on the DIFC model of Dubai. So lots to look out for. And I would urge all of you, because there will be a lot of employment generation in that space as well. It's a new booking center altogether. Every bank will get in over there. So worth investing yourselves into it.
Very, very good points, Nikhil. And I think it's a big focus area, especially Gift City, whenever we read about it and the kind of capital flows we expect in the years to come. Again, sticking to capital markets, to you, Professor Harsimran, I think what Nikhil talked about, reserves and all, but a different kind of reserves. I think we're seeing that because of the kind of global policies, the reserves in dollar are more under threat, where people are, central banks are moving towards non-dollar and to other, sectors, other sort of securities. The other safe haven have been commodities, and we've seen a huge run up in silver, gold, bullion, to say the least. What do you see it? How do you see this kind of a thing playing out, the kind of risk to de-dollarization and commodities play over the next couple of years? What's your view on it? And Indian investors in that context, possibly.
So, see, look at this this asset class as a demand and supply, am I right? And equities is obviously about cash flows. You put it to present value, and gold is always about because you have a limited supply, and so a lot of now countries are moving there, and they've been buying gold in large quantities, am I right? And that has been and there is fear of geopolitical risk, and gold has been the asset class which is extremely done well. But I still believe investors should hold not more than about 10% in the portfolio, because of the fact that it's very difficult to predict an asset class demand or supply in a very long period. So
Right.
if you ask me what will be the gold price in next 4 years, I don't know. But I can definitely look at next 3 years because of whatever geopolitical things are happening. So from an asset class point of view, I think 10% is a good allocation to have, and there are many multi-asset class funds which have exposure to gold. But I would be a little cautious because it has run up very fast, and the concept of mean to back to the mean would be very fast in this case, and the recent volatility kind of speaks about that. So any investors who are raising golds in a portfolio to a very large extent could be at risk. And this thing, because purely because it's very difficult to predict, is easier for equity markets and debt to kind of put to a pricing part.
Yeah.
Pricing gold and similar commodities will be extremely difficult.
Yeah, I think very well highlighted in terms of the risks that come in, and especially in light of the recent run-up. Great. I think we've had a lot of questions that the panel has deliberated. Maybe we can open the floor for Q&A at this point of time. And let's see what are the kind of questions that the audience have, if at all. Yeah. You can raise your hands if you have a question.
So a lot of discussions regarding capital expenditure, the type of expenditure that needs to be done, regulatory reforms, and also a lot of discussion about the bond market, especially diverse opinions. But I believe diverse opinions are what brings more insights for the audience. The floor is open for discussion. So if there are any more questions from the audience side, please feel free to ask.
There's a hand there. There's a hand there, yeah. Yeah. Second row.
We now open the floor for the much awaited Q&A segment.
Good afternoon, esteemed panel. I have a question specifically for Satyanandan sir. This question is something I've been troubled with for quite a while now. You partially answered it during the discussion in terms of acknowledging that there is a fairly significant gap in terms of what level of sophistication exists in the field of risk management education versus what is actually being practiced in the industry today. So I won't ask my first part of the question. My second part of the question would be, what can policymakers as well as us as responsible finance professionals can do to bridge this gap between what we know about how to manage risk while dealing with financial assets versus what we actually do in the industry? What are the next steps for my generation?
Your good name?
Name is Adit Turmala, sir.
Adit.
Yes, sir.
Adit. So Adit, well, from a risk education, it's a very early venture for me, a very early exposure. I have recently been part of the advisory committee of the Global Association of Risk Professionals, and from the India perspective, and we are a team of 6 people who are part of it, and the primary objective is also about risk research and risk education in India. We are also approaching the regulators, the RBIs, the SEBIs, and the IRDAs of the world. So I don't have much expertise in this domain, though I'm very early, who was exposed to. I'm more of a practitioner. I will not say even a practitioner. The practitioner gets theoretical. I need to be practical because I'm part of the business, and the business doesn't like theory. I'm telling you, as we are part of the education, is an education institute, and we are all practicing, or I would say, getting into understand the concepts. But one thing I will leave with you all: once you come into profession, there is an element of education, there is an element of practice, and there is an element of practicality of what is to be done in the business. Business is all about taking risk. Business is all about taking risk. The guardrails, the boundaries have to be practical enough not to throttle the business, but to enable the business. So from a risk education and what you said about what is to be, practice, I think that is I would say the summary of the concept. You have reading about credit risk, you have been reading about hedging, you have been reading about multiple complex derivatives, everything in your courses. When you come to your professional world, you would understand multiple times you don't use derivatives, you don't do hedging because it is not required. You may say that I may do it, but it is not required. So I think the game is all about understanding the concept deeply. But when you come to implementation, you should have a one step back. You should have the ability to understand kya karna hai, nahi karna hai, and to what extent. Does it throttle the business? Does it enable the business? So I think risk education is all about regulator has a viewpoint who is a practitioner and who all talks about guardrails in protecting the organization from a sustainability. It's a business, continuity of operations. The business has a mindset of taking risk. So it is a balance between what a regulator and a chief risk officer will talk about, to what it wants to attain, to what boundaries a regulator creates. It's a balance. And the risk guy has to balance all this. So you need, as from a point of view of your education standpoint, you need to get into the deeper concepts. But don't always believe what you learn is to be implemented. That's
Maybe I'll just take the liberty to add here if I got the question right. See, in academics, you focus on risk largely from a credit risk perspective, and often every conversation is about credit risk. But when you actually come to the business, the biggest showstopper, credit risk can actually be defined through risk appetite statement. So every bank, every function, every department will have ability to absorb risks. You will have provisionings, etc. That is a business call. But with the area of low tolerance, something which can actually change careers, throttle careers, is non-financial risk. We call it NFR. That actually has the biggest reputational damage that can happen to an organization. So as you like he said, the practicality of it is defined on the credit risk matrix. You're in the business of taking risks. You'll define it. You'll have matrix for it. But the moment you have non-financial risks and issues blow up on it, there is very little tolerance for it. And that's an area you often may or may not discuss too much in the academics bit, but that will actually be a disproportionately large piece.
Very well mentioned, Nikhil. I think reputational risk is the biggest risk for large organizations. In fact, that's what gives any CEO of a large company sleepless nights, because brands, if they get tarnished, recovery, the impact is overnight, but the recovery takes very long, right? That's the problem. So yeah.
Thank you so much.
Next question. Yeah, the lady in one of the left middle row. Yeah, if you could raise your hand.
Good evening. My name is Rishika Datta, and I'm currently pursuing PGDM Finance at IMT. So my question was to Hina Kamra ma'am. As you mentioned that corporate bonds are being rated by international agencies and not given as ideal ratings as would be useful for us. So how do you think we as investors could understand how risky corporate bonds or other sort of bonds are in the Indian context? And what do you think is the ideal allocation that we should give to bonds or G-SECs in our portfolios? Thank you.
I think I would like to correct that. That's not what I said.
The country rating.
We were just discussing the country rating, where I said the India's sovereign bond rating is by international agencies. We're not talking about the local bonds, the domestic bonds. So there you have certified credit rating agencies like CRISIL, ICRA, Fitch, India Ratings. So who actually rate all debt market instruments, bank borrowings and all, which are reliable ratings. Of course, there is benchmarking of these credit rating agencies, which happens where some are up there and some are below there. And accordingly, you need to look at those instruments that are there. Now, if you're talking about allocations to corporate bonds, I think Nikhil is a better person to say in what part of the cycle you should do it. Currently, as a house view, our thought is, and I'll give you an interest rate scenario right now. It looks fairly benign. Like I said, the environment is conducive to a little more easing. There are no more shocks expected. NPAs have been resolved. Credit cycle is still okay. It is not, it's not gone out of whack. We still have way to go. So bonds look safe. Having said that, what we feel is that in private credit, so long as, of course, you understand it, we are overweight on private credit. That's where actually the value comes. But of course, you need to understand exactly what you're doing in the private credit space.
Thank you.
Yeah, next question. Yeah, on portfolio allocation, I think Professor Harsimran's course will cover in terms of the kind of allocation you would have according to risk appetite. So probably you might want to attend that one.
Good evening. I'm Karan Chawla and I have a question regarding the India's corporate bond market. Most discussions which we had on developing India's corporate bond market, we discussed about participation, regulatory reforms and liquidity. But to what extent do you think that institutional factors like judicial enforceability, slow insolvency resolution and insolvency state, corporate relationship affect investor confidence in corporate bonds?
Okay.
Could you repeat
Yeah,
the
the question is on
please?
insolvency and enforceability
I didn't understand your question.
on the corporate bond market. So there are issues around judicial enforcement, insolvency, etc. How do these affect and how can this be sort of addressed? I think that's the question, right?
Yes. And the main risk is not only the business risk, but also the recovery and the insolvency.
Recovery, I mean, basically recoveries.
Actually, India's come a long way in
Yeah.
the last 5 years. That's the single biggest thing that has happened in the last 10 years is the IBC,
Yeah.
Insolvency and Bankruptcy Code. So earlier in India, you had a couple of other mechanisms that existed, but the way it would work was that it would take 10 years, 20 years, and it is actually the lenders who would blink. At the end of the day, after 20 years, they would have written off most of the things and the promoters would manage to get their assets back despite having defaulted.
50, sir.
Right. So it was, that's how business was done. In 2015 or 16, the whole system was revamped and the government came out with IBC, the Insolvency and Bankruptcy Code, which has been working out well in terms of at least the insolvent guys coming to the table and negotiating with the lenders to work out solutions. Because for the first time, they're actually worried they could actually lose their third generation businesses. And there have been a lot of highly publicized cases, if you look at it, where third generation businesses have been liquidated by the lenders. So having said that, while this has started working and it's working very well, the efficiency of the system needs to be improved because the number of cases that are getting resolved needs to move up because there is a lot of activity at the ground level. But definitely, if you look at, for instance, ARCs, I think started happening in India somewhere around 2010, which is asset reconstruction companies. So what do asset reconstruction companies do? They buy out the NPAs, non-performing assets from banks and other lenders, and their job is only to resolve. So let's say the loan was 100 rupees and 50 rupees was pending on account of the interest rate. So 150 rupees was due, interest rate dues. So the bank writes it off totally or to whatever extent and sells these to the asset reconstruction companies who in return issue SR, securities receipts, in which banks may choose to invest or not, depends on the scheme, and you should study more about it. It's an entire course in itself. It's a field in itself. But the whole system has been working very well. How it can be supplemented is, again, like I said, the development of the yield curve. For instance, ARCs are restricted from doing certain things. So those areas need to be opened up. So the corporate bond market for the junk bonds, which are not actually junk, but anything which is sub-investment grade in the overseas market is called a junk bond. And it may be totally recoverable. Anything which is about 20-25%, of course, it is recoverable. So those markets need to develop further. And with the advent of specialized institutions like ARCs, it will develop further. So it's just the number of instruments that they can invest in needs to go up now.
Great. Last question, if at all. Otherwise, we can wind up. Yeah, one last question, unfortunately, before we wind up.
Good evening, panelists. My name is Shabda Shaji. My question to the respected panelists is that, as we all know, that India has recently signed FTAs with many nations and many trading blocs such as EU, UAE, and EFTA trading bloc. Also, the fact that also the fact that the government has enacted various schemes such as PLI schemes and Bharatmala logistics schemes to enhance logistics in the country so that our exports could be competitive. We also know the fact that the Indian rupee has set at 90 rupees per dollar, etc., and the RBI has interfered by selling our reserves of $600+ billion to stabilize the rupee. My question is that how could the stakeholders, such as the government and the RBI, interfere in such a way that our exports remain competitive, whereas the rupee doesn't fall to such an extent that the Indian consumer may not get crushed by the expensive imports?
Okay. Yeah. Quick. Yeah, I think everybody has a view, but maybe a quick 30-second take from all.
Yeah, so I think the export competitiveness, and especially if you've seen the rupee fall in the last 8-9 months, it's fallen. Professor Saab earlier spoke about the dollar index, right? It actually moved from 113 peak to now at around 97. So it's almost like a 16% or 18% fall in dollars. Whereas actually on the contrary, rupee is also fallen. Now the story was till the tariffs were applied on India, Indian rupee was actually on a real effective exchange rate basis, rather appreciated, which was actually hurting our export competitiveness. So when the tariffs got imposed, the only option to keep ourselves competitive, we were at a tariff rate of, let's say, then about 50%, and you had a competing markets of scale, let's say China at 37% and a few others, Vietnam, etc., were somewhere around 19 to 20%. So you had a very big disadvantage to cover, minus the tech and the pharma, because they were exempted. Now you had to correct, so the rupee obviously took a fall, and now from the 2013-14 to now, you are actually you're the lowest level on a real effective exchange rate basis. 2013 is the time when you were part of the fragile five, Turkish lira and all of these. We were the worst performing currency, and we had almost like a huge outflow, and that's the time the FCNR deposits were raised by the then governor RBI, right? So that was an extremely negative scenario, but that's the lowest level again we are at on a real effective exchange rate basis to get the rupee to be, so which is why you had to, because you had to compensate for the tariffs. The view now is it can change dramatically because the tariff story is now hopefully behind us. And this allows leeway for a lot of the ETF money. Two kind of FI money comes in. One is the long-term money, and the other one is the ETF hot money. So the ETF hot money is still negative on emerging markets overall. So that we're not expecting a lot to come in. But a lot of the stable long-term FII money or FPI money should start to pour in, both in the equity and the debt side. And so the view is that it should be a lot more closer to 88, 90 than to 95 era. So, and the only other thing is we don't expect RPI to actually, they will largely, if you get a lot of FPI inflows, they will be very inclined to suck the dollars out of the market, build reserves, rather than let the rupee appreciate, because they still want to maintain rupee competitiveness and stability of the currency. That's the point.
I'll just say one thing, when the rupee falls, we should not think of the rupee as a symbol of national pride. A strong currency is not a symbol of national pride. So there were a couple of years before the current RBI governor took charge, where we did keep our currency stable for a fairly long period. While other countries, the currencies with the nations with whom emerging markets with whom we compete in the export market, their currency is depreciated. So My personal view is you should always let your currency move in the right direction on a continuous basis instead of maintaining it at an artificial level. Number two, no currency, we should never allow our currency to be volatile. So a 20-30% move in a currency, or even a 20% or a 10%, impacts FDI and FII flows. And also, it impacts the ability of businesses, exporters, importers to do a proper planning. So RBI does have a band of volatility. Typically, that band is supposed to be around 5% on either side. But for a couple of years, RBI preferred to maintain it very, very stable. Again, just like Nikhil said, we are now just about getting competitive, and it's not a symbol of national pride. Whether it appreciates or depreciates, I will not give a view on that. But yeah, we should move it in tandem with the global currencies with whom we are competing. And also, we should track the INR CNY rate. That's actually the.
Yeah. Thanks. Great. Yeah.
So just quickly on 2 points. I think the kind of money we want FDI, and we need to find a strength, what kind of exports we want to expertise in. Am I right? We can't export everything under the sun. So we want certain key areas of export, like pharma could be one. There could be services. So depending on, we have to find our key expertise area, and we have to be competitive in that.
Great. Great. Yeah, go ahead.
A sincere thank you to all our esteemed panelists and Gaurav sir for such an enlightening and thought-provoking discussion. This panel has truly showcased the rich experience, expertise, and wisdom of our distinguished speaker. We also want to express our gratitude to engaged audience whose participation has made this session a resounding success. Now I would like to invite Dr. Harsimran Sandhu sir to deliver the vote of thanks.
So I think it's a very rare panel that we have got such expertise, people from the banking side, Kamra from real estate, bond market, risk, Satyanand. I think a big thank you to all of them, making out time, coming to IMT Ghaziabad. Thank you so much. A big thank you to the Finis team for making this up. They do it every year, and the entire coordination is done by the Finis team. A big thank you to the Finis team as well. And above all, Gaurav, the moderator, you steered the conversation very well. We went into the right direction and also asking the right questions. Thank you. Thank you so much.
Thank you, sir, for your valuable words. Now we would like to request Professor Arit Chaudhary. Please felicitate our esteemed guests, starting with Nikhil. Thank you, sir. Dear panelists and faculty members, we invite you to come forward for a group photograph. As someone wisely said, we do not remember days, we remember moments. Let's capture this special occasion on a lasting memory for our insightful gathering.
I think we cannot miss giving the memento to Gaurav. No. Please give a huge round of applause. We've been driving a good conversation. Thank you so much, Gaurav.
Now, we would like to invite the panelists and the faculty members to come forward for a group photograph. Now, we request the team finesse to join us on stage for the official photo as well.
Can I see? The team who organized it. Can I see? I think we should have a big round of applause for the ministry.
Yeah.
हमारी फोटो हो गई आपको you should come closer, or you want to come in the front and sit someone. Okay. Some people want to sit there. Yeah, you will be. If you can sit over there, and something sit there also if you want. That will be wonderful. You can sit here. You can be back.
Thank you.
Now we request all the guests and faculty members.
Yeah, I think you should.
Now request all the guests and faculty members to please proceed for high tea.
Whatever you
Volunteers,
want to
please escort
them.
us.
ये छोड़ दो क्या
इसमें से कुछ चीजें ये ले
ये आप लोगों ने मेल किया था
आपको मिला
मिला
compiled.
It's very nicely done actually. Indian financial system, professionally done. I gave it to my team to study actually. Yeah, the youngsters know. Actually, you should study that.